Hello everyone. I think we're going now. Sorry about the slight delay there. There should be a raise your hand icon. If somebody could, or a few people could just press the raise your hand icon just so that we can check that people can hear us, that would be really good. Okay, we seem to be missing the handouts for the moment. Don't worry, they'll be available afterwards. Somebody said they can. There is. So don't worry about the handouts for now. It's the same information that will be on your screen. Just take some notes and we'll make the handouts available later. Okay, so let's get started. My name is Julia Fletcher and I'm the Financial Accountant for Charity Services, and I'll be joined shortly by Amy Lewin from the External Reporting Board to take you through this presentation. So we welcome you to ask questions during the session. You do this just by clicking on the questions button, which is on the control panel on your right hand side. Just type your questions in as they come to mind, and we will try and answer as many of those as possible at the end of the session. If we don't get to your question, then we will be collating all the questions and we will put them in written format. We'll either email them out to everybody or put them on our website. If at any time during the session you experience sound problems such as an echo or feedback, if it persists, you might consider using your phone instead. Just select the telephone option and dial into the audio, enter the access code and audio PIN when prompted, and these are provided right there on the panel on the right. So before we get started on the material, we're firstly joined by Jane Pierard, who's the Manager of Engagement and Business Improvement at Charity Services, and Warren Allen, who's the Chief Executive of the External Reporting Board, who are going to speak to you briefly on why we're undertaking this process of change and the importance of the new financial reporting standards for us as a nation.
Hi, I'm Jane. From the Charities Services perspective, we're really pleased that the new accounting standards for charities are finally here, because we really believe this is going to enhance the quality of reporting for charities in New Zealand. Up till now, as you probably know, there have been no minimum standards for charities' financial reporting, and this has meant there's been a really diverse range in the quality of reporting, and that's certainly what we've been seeing for the past few years. The clarity and consistency that these new standards will provide will mean that people reading the performance reports of charities will be able to make better decisions, and will be able to collect more useful data about the sector as a whole. And this is really important when making decisions at the government level about where resources are needed. At the same time, we do acknowledge this is a huge change for charities and will take some time, and we're really behind supporting charities to be able to do this. The standards will also help to promote better governance internally, as charities will be able to clearly articulate why they exist and also measure their progress from one year to the next. And all of this helps to make New Zealand a better place for New Zealanders, and so I'm delighted we're able to share this knowledge with you today. Thank you so much for taking the time to learn with us today.
Good afternoon, everybody. I'm Warren Allen. New Zealand's 27,800 charities add significantly to the quality of life in this wonderful country of ours. A considerable percentage of the population donate resources, including money and time, for charitable activities. We have witnessed a mammoth global change by the donating public, requiring higher levels of accountability and transparency relating to the use of their donated resources. Therefore, to maintain the vibrancy of New Zealand's charities, the compliance with this new accounting framework is critical. It may take a couple of years for high levels of compliance to be achieved, but it is now essential to be aware of the change, give it your very best attempt, pay attention to the detail, and learn from others to improve upon the first year's effort. There are many avenues of help available to you. Accountants are vital to ensure the benefits of this change are fully delivered, and I trust that this webinar will encourage you to embrace the change in charities financial reporting and give you the opportunity to add real value to the charities that you serve. Thanks very much for joining us today, and I wish you well for this webinar and have pleasure in handing back now to Julia.
Thanks very much, Jane and Warren, for setting the scene as to why this is such an important change for charities in New Zealand. So now let's get started with the material. The new accounting standards for Tier 3 and Tier 4 entities have been written with the intention that both accountants and non-accountants will be able to follow them. Therefore, the main objectives of this webinar will be to ensure that you come away with a high-level understanding of what has changed and what to look out for. So our presentation will include a broad overview of the standards framework within New Zealand and the way changes for charities are part of the financial reporting review that has been underway during the past few years. The key aspects of the not-for-profit reporting standards that are different from older reporting standards. And we'll go over the new assurance requirements for charities as well. Remember, if we haven't gone into enough detail for you by the end of the presentation, you can always refer to the standards directly. I'm now going to pass over to Amy from the External Reporting Board, who's going to explain to us how we have arrived at this point and how it all fits together.
Right, now that I'm logged in.
Good afternoon, everyone. Thank you for taking the time to join us. It's great to see so many of you watching our webinar. My name is Amy Lewin, and I'm the Project Manager of Accounting Standards at the External Reporting Board. The Financial Reporting Act 2013 was updated at the end of 2013. All you need to know about this Act is that it gives the External Reporting Board, or the XRB for short, the mandate to set financial reporting standards for a number of for-profit and not-for-profit entities, including registered charities. The other significant act that was passed was the Financial Reporting Amendments to Other Enactments Act 2013. This act amends a raft of legislation such as the Charities Act 2005, the effect of which is to specify which entities need to prepare financial statements in accordance with the XRB standards. In your case, all registered charities have to apply our standards for periods beginning on or after 1 April 2015. This is in Section 42A of the Charities Act 2005. In New Zealand, we now have a multi-sector, multi-standards framework. This means we have different standards for for-profit entities and public benefit entities. Public benefit entities, or PBEs for short, is defined as reporting entities whose primary objective is to provide goods or services for community or social benefit, and where any equity has been provided with a view to supporting that primary objective rather than for a financial return to equity holders. A for-profit entity is an entity that is not a PBE. You're watching this webinar because the entity that you're involved with is a registered charity and by definition is likely to be a public benefit entity. There are 4 tiers of reporting requirements. The tier structure was developed to match the benefits with the costs of preparing general purpose financial reports. As you go down the tier, the smaller the entity, the obligations become simpler and thus the compliance cost is reduced. The standard is different based on the tier that you are in. This webinar is for charities with operating expenses of less than or equal to $2 million. This is either Tier 3 or Tier 4. Not all registered charities are the same. Approximately 97% of registered charities have operating expenses of less than $2 million. We developed the 4-tier accounting standards framework largely based on the size of the charity. Size here is based on the charity's operating expenses or operating payments. The Tier 3 and Tier 4 standards are much simpler than the Tier 1 and Tier 2 standards and considerably smaller in size. They were written with non-accountants in mind, so it's less technical than the accounting standards that you may have read in the past. The Tier 1 and Tier 2 requirements comprise 38 standards and 1 authoritative notice, being the PBE conceptual framework. In total, these standards are over 1,000 pages long. If you compare this with the Tier 3 standard, the requirements are approximately 40 pages. The Tier 4 standard is even smaller with approximately 18 pages of requirements. The Tier 3 and Tier 4 standards are based on research of the transactions that not-for-profit entities commonly enter into. So we didn't develop these standards without the proper research. If you elect to report under a particular tier, then you need to apply the requirements of the whole standard. You can't pick and choose requirements from different standards. We have 2 versions of the PBE standards. So we have one version for the not-for-profit entities and one version for the public sector entities. So if you are a public sector entity, then you'll need to apply the public sector version. If you are both a public sector entity and a registered charity, then please speak to the Officer of the Auditor General on the appropriate version that you should be applying. The criteria for Tier 3 is total operating expenses of less than or equal to $2 million. Total expenses is determined for the whole charity or the group where there is a group for financial reporting purposes. In very simple terms, a group is where there is a main charity like a head office that controls another charity or entity for financial reporting purposes. This other charity could be a branch. Control here is a very specialized term used in financial reporting. If you think you could be in this situation, please seek professional advice. To qualify for Tier 3, total operating expenditure for the whole charity or group is less than or equal to $2 million. Operating expenses are your day-to-day expenses. So these include costs of fundraising and any grants that you may make to another charity or another entity. Expenses also include reductions in the value of property, plant and equipment. This is called depreciation expense. It's all your outflows that you've incurred during the year other than your capital outflows or purchases. Examples of capital outflows are repayments of borrowings and purchases of fixed assets. These are not operating expenses. Tier 3 charities apply accrual accounting. Accrual accounting is where transactions are recognised when they are earned or incurred. Adjustments are made for year-end debtors and creditors. Accrual accounting includes depreciation if you have fixed assets. The Tier 4 criteria is total operating payments of less than $125,000. Operating payments are your day-to-day expense payments. Operating payments do not include capital payments. So for example, if you buy a motor vehicle for $10,000, this is a capital payment and is not included in the operating payments total. If your charity invests $5,000 in a term deposit, this is not included in the operating payments total. This is just a transfer of money to another bank account. Tier 4 charities apply cash accounting. Under the cash basis of accounting, transactions and other events are recorded when the cash is received or paid. Cash accounting does not include depreciation because this is not a cash activity. So if you currently do depreciation or accrual accounting and you want to continue to do so, you can elect up to Tier 3 and apply accrual accounting. You always have the choice to opt up to a higher tier of reporting. The official title of the Tier 3 standard is Public Benefit Entity Simple Format Reporting Accrual Not-for-Profit. So this is quite a mouthful. So for simplicity, we will refer to this as the Tier 3 standard. So as already mentioned, the Tier 3 standard is an accrual basis standard. Revenue and expenses are recorded when they are earned or incurred rather than when the cash is received or paid. Financial statements prepared under the accrual basis include adjustments for the timing of revenue or expenses. They include items such as debtors, which is money owed to the entity, creditors and accruals, so this is money owed by the entity, and depreciation. Financial statements prepared in this manner more fairly represent the financial performance and financial position of the charity. We've also developed explanatory guide. So this is EGA 5 for Tier 3. So the explanatory guide is written in more plain language than the standard and is designed to be even more user-friendly. The guidance notes include tips and highlights, important pieces of information, has examples, and it cross-references back to the standard. In addition to the explanatory guide, we've also developed templates. So these templates are optional, but if you complete them correctly, they will meet the requirements of the standard. The templates are designed to cover most circumstances, but not everything. So if there are matters that are significant and necessary to include for users of your performance report, which are not provided for in the template, then further details should be given by means of additional notes. If there are things in the template that are not applicable to your charity, then they can be removed. The templates are in PDF and Excel format and are available from both Charity Services and the XRB website. The official title of the Tier 4 standard is Public Benefit Entity Simple Format Reporting Cash Not-for-Profit. Again, for simplicity, we will refer to this as the Tier 4 standard. So this standard is under the cash basis of accounting. Transactions and other events are recorded in the performance report only when the cash is received or paid. For most entities, this will involve taking their cash book and summarising the receipts and payments for the financial year. The Tier 4 standard also has an explanatory guide. This is EGA 6 and optional templates. So if you find the standard a bit daunting, then start with the templates and the explanatory guide. Then you can refer back to the standard if both of these documents are not clear. So this is the External Reporting Board's homepage. So you have your own purple button on our website. So by clicking on the purple button, you'll get to all the standards, explanatory guides and templates for all the tiers for all the not-for-profit entities. So rather than clicking on the purple button and then scrolling to find what you need, we have made it easier for you. So we have quick links to the Tier 3 and Tier 4 templates on the right-hand side of our homepage. So this is where the arrow is pointing to. So when you get to the templates, above these are the explanatory guides and the standards. We also have quick links to the frequently asked questions. So I'll now pass you back to Julia, who will go through some of the requirements of the Tier 3 and the Tier 4 standards.
Thanks very much, Amy. Now, I know we had a bit of an echo going on before, but I think we've resolved that problem, so hopefully you can hear us clearly now. We've now had a look at the thinking behind the standards, so let's have a closer look at what makes up the performance report. You will recall that the Tier 4 standard uses cash accounting and is for organisations with less than 125,000 annual operating expenses. So what does the Tier 4 performance report actually include? You can see from the diagram there are several parts to the report. It includes both non-financial and financial information, as well as some further supporting information when that is helpful. Overall, it is designed to show simply why the charity exists, what it has been busy doing, and how the money came in and out. Under the Tier 4 standard, the profit or loss and the cash flow statement are combined, and this becomes the statement of receipts and payments. This literally shows all the transactions in and out of the bank account divided between operational and capital transactions. This is then reconciled to the bank balance. Instead of a balance sheet, you have a statement of resources and commitments. The key thing to note with this is that it is simply a list of the significant things the charity owns or owes. It does not include any retained earnings and does not need to balance. One reason for not including a balance sheet is that the cash standard has been written for very small organisations with very few transactions and potentially limited accounting expertise. The notes to the performance report include accounting policies and also state which standard has been followed and the GST treatment. Remember that Tier 3 is for organisations with less than $2 million annual operating expenses. You can see that the Tier 3 performance report is similar but different. Again, it is designed to tell the whole story of the organisation, so it includes non-financial information to set the scene and provide the context, followed by financial statements. The financial statements are different because Tier 3 uses accrual accounting, and there is also a cash flow statement included. To be clear, this shows the cash movements in and out of the organisation over the past year. It is not a projection of cash flows or a budget for the future. The cash flow statement shows quite clearly whether more money came in than went out during the year. Tier 3 is also designed to show simply why the charity exists, what it has been busy doing, and how the money came in and out. We'll talk a bit more about the non-financial information first. This comprises the entity information, who we are and why do we exist, and the statement of service performance, what did we do and why those activities. The purpose of including the non-financial information in the performance report is to tell the story of the organisation. It's that story that engages people to want to volunteer or donate. It's also an ideal avenue for funders to see the overall mission of the charity. Providing the entity information and the statement of service performance sets the context for the financial reporting, shows the awesome work that is done, and this document could also be used to showcase your charity. The performance report is publicly available on Charity Services website, and we have about 44,000 hits a month. So that means that members of the public, funders, media, and other stakeholders are looking, and therefore it makes sense to put your best foot forward when preparing your report. If you pair financial and non-financial information together, you can see the amazing work that charities have achieved and understand their purpose a lot better. I'll explain this with an example of a performance report I recently read. So a wildlife charity submitted their annual return to us, and they basically attached their bank statement as their financial information. It showed that they had 99 cents at the beginning of the year and 99 cents at the end of the year, with a handful of in and out transactions. So what does that tell us about what they do? Not very much. When I asked them to resubmit their report, I could see that they had rescued some 30 animals during the year using volunteers, and they explained that they wished they could have done more, but they didn't have the funds to do it. A full performance report illustrates to stakeholders that this group is active and shows how much work they have achieved on next to no money. Preparing the performance report is also a useful activity for the charity itself, as it shows the importance of good record keeping, and they can look back on the year's work and see how much they have accomplished. Here is an example of the Statement of Service Performance, which has been prepared using the template that the External Reporting Board developed. The template is optional and can be found on both Charity Services and the External Reporting Board websites. This example is for a Tier 3 fictional charity. Both Tier 3 and Tier 4 need to provide information about their outputs. Outputs are the specific activities that the charity undertook during the year. So for this example, the outputs are antenatal courses and Great Start Parent courses. This charity has measured these with the number of classes and the number of attendees. Tier 3 charities are also required to provide an outcome statement. This is optional for Tier 4. This statement provides a high-level description of what your charity is trying to achieve. In this example, it is information and advice is available to help parents make informed choices for birth and parenting. Families receive postnatal support and opportunities to network with other parents. The outcomes are not a description of what you have done during the year, they are what you are trying to do. This can be a bit of a tricky concept at first, so it's a good idea to make sure you clearly understand the difference between outputs and outcomes before you start. You are not asked to prove that your outputs led to the outcome. Instead, the outcome statement explains why the activities are a priority for your organisation. When you are reading a statement of service performance, you should be able to make the link in your mind of how the outputs stated relate to the outcomes of the charity. You will notice that there are some red asterisks on the example template. An asterisk indicates that the information is required. You will note that the budget column does not have an asterisk. This means that you do not need to include your budget if you choose not to. There is also an exemption in the first year of using the new standards from restating your prior year numbers. So even though the last year column in this example has an asterisk, you do not need to complete this column in the first year if you don't want to. We'll move on to the financial information now. There are some specific parts of the Tier 3 and Tier 4 standards that are different from previous standards. We'll go through categories, recognition of certain transactions, and related parties on the next few slides. But firstly, we'll discuss the basis of preparation. So essentially, what it means to elect a particular standard. Most people have had some awareness that there is now a requirement to include non-financial information in the performance report. But for some people there has been the misconception that in order to comply with the new standards, all you need to do is add a statement of service performance to an old-style set of financial statements. This is not the case, and therefore care needs to be taken when preparing the performance report, as there are certain components that need to be updated. It's important to recognise that Tier 4 is a cash standard and Tier 3 is an accrual standard, and therefore the way the information is presented is different. For example, you could not say you were adopting a Tier 4 cash standard and then actually present the information like an accrual set of accounts. It's not a case of doing more than what the standard requires, it's a case of electing a standard that you are entitled to follow and then adopting that entire standard. For either tier, the steps to follow would be 1. Take a look at the Excel template so you can see how the report fits together. 2. Use the guidance notes to help you through the template. 3. If you still have questions, refer to the standard itself. And 4. If you're still stuck, then ask a person for help, an accountant or charity services, for example. One of the key features for the new standards is that there are minimum categories for the money coming in and going out of your organisation. This slide shows the minimum revenue categories for Tier 3 and receipt categories for Tier 4. We are only showing the revenue and receipt categories as the expense and payment categories are relatively self-explanatory and the questions we receive are usually about the income categories. You will notice that there are subtle differences between the Tier 3 and Tier 4 categories. This is to reflect the fact that there are different ways of accounting. This includes the fact that the capital receipts are included in the statement of receipts and payments in the Tier 4 standard in order to make the transactions balance to the bank account. The purpose of the minimum categories is to promote consistency across different charities and across different time periods for the same charity. However, it is acknowledged that some of the category names may not be the most appropriate for your specific charity, and therefore there is some leeway in the standards to alter the categories, which we'll go into on the next slide. There is scope to tailor the categories to your organisation. However, it is really important to maintain the intended purpose of the minimum categories. The categories have been specifically written in order to give the reader an understanding of by how much the charity is self-sufficient versus reliant on external funds, and also give a sense of what the money raised is used for. For these reasons, it's important to maintain the integrity of the categories and not mix them up. For example, you must keep separate money received from members versus non-members, and you wouldn't mix up your income from fundraising with your interest income because they are in two different minimum categories. You will also notice that there is no minimum category for grants. This is intentional and therefore you cannot just add a category for grants without thinking about what each grant was for. We will go into grants a bit more on the next slides because this is an area that has changed quite a bit. There are a couple of things to think about when recording grants. Firstly, you need to decide which category best fits the intended purpose of the grant. For example, if the grant was for general administrative purposes with no conditions, you would record it under donations, fundraising and other similar receipts, or in Tier 3, donations, fundraising and other similar revenue. As I said previously, you cannot just have a category for grants. If it was specifically for the provision of goods and services, for example, for food to put into the lunches of needy children, or another example could be a grant for a government contract for providing healthcare services, it would go into revenue from providing goods and services, or in Tier 4, receipts from providing goods and services, which makes sense as the money pays for the delivery of goods and services. Secondly, you need to decide when to record the grant. It's essential to know if the grant has any conditions attached to it, in particular use or return conditions. This means that if you do not use the grant for the specified purpose, you are contractually obliged to return it. If there are no conditions, you record the grant when you receive it. If there is a use or return condition, for Tier 3, you record the grant as a liability and then recognise the revenue and expense as the grant is used up. And for Tier 4, you recognise the grant when it is received and you would list the unused portion as a commitment in your statement of resources and commitments. This table summarises which category to record grants under and when you record the grant as revenue or as a receipt. This is different from previous ways of accounting for grants where you might be familiar with matching the grant income and expenses. This is a key change, so you now only record the grant as income in advance or as a liability when there is a contractual obligation to use or return the grant. The Tier 3 standard contains a comprehensive table of when to recognise transactions and at what value. The guidance notes also offer additional explanation to help. I've just selected a couple of transactions which are particularly relevant and have been tricky in the past for charities trying to apply previous standards. The new Tier 3 standard makes it much easier in that you do not have to record things that you can't really find an appropriate value for. For example, donated clothes for an op shop. Charities are now required to report their related party transactions in their performance report. Related parties are people or entities that have significant influence over the charity, such as office holders, committee members and others involved in the strategic management of the charity and their close family members. Related party transactions are really common in the not-for-profit sector, and that's not a negative thing. It's really good to use your networks and get people to do things for your charity for less than you would normally have to pay. You need to disclose related party transactions if they are significant or if they are not significant but are not on commercial terms. Transactions can involve cash or non-cash donations, such as providing goods or services, also called in-kind. You need to include in your performance report a description of the relationship, a description of the transaction and the amount paid or received, and any amounts payable or receivable at year end. It's a protection to a charity's reputation to clearly and simply state these kind of transactions. In the webinar that we did this morning, we had quite a few questions about related party transactions. So we've got quite a bit of material on the Charity Services website that you might like to have a look at, which would probably help with some of those questions. I'm now going to pass you back to Amy, who's going to discuss the new audit and review requirements.
So far, we've been talking about the standards developed by the XRB that guide your reporting to charity services. At the same time as this change, the Charities Act was also amended for the assurance requirements for certain charities. Some but not all charities in Tier 3 will be affected. There are new statutory audit and review requirements being introduced to medium and large registered charities. These also came into effect from 1 April 2015. This new legislation defines which charities must undertake an annual audit and which ones must choose between an audit or a review. It also defines who can do that audit or review. If your charity has operating expenses of greater than or equal to $500,000, then the performance report shall be audited or reviewed. If your operating expenditure is greater than or equal to $1 million, it shall be audited. Under the changes, statutory reviews or audits can only be provided by qualified auditors. The legislation says a qualified auditor is a chartered accountant or a licensed auditor or a member of another association of accountants outside of New Zealand. This table provides a summary of the reporting and the assurance requirements. Please note that the criteria for reporting and assurance is not the same. This is because the requirements for reporting and assurance are different. At this present time, the Statement of Service Performance is not mandatory for Tier 1 and Tier 2 charities. We have a current exposure draft which intends to make this mandatory. This exposure draft is currently open for comment, and comments are due to the External Reporting Board by the 29th of July. Which is this Friday. The proposal is for a two-year implementation period before the final standard will be effective. So this means that if we issue the final standard next year, it won't be effective until 2019. So if you're involved in a Tier 1 or Tier 2 charity, we would be very interested in hearing your views on the exposure draft. The comments don't have to be formal. A simple email would be sufficient. So this exposure draft can be accessed from the External Reporting Board's website. And the document is called ED NZASB 2016-6 Service Performance Reporting. I'll now hand you back to Julia, who will provide a wrap-up of this webinar.
Thanks very much, Amy. So before we finish up today, I'll just let you know that there's plenty of additional help available to you. We've got lots of guidance on our website, including videos, tutorials, templates and guidance notes, and I'll show you where to find this all on the next slide. People can help you too. You can email or ring us. Our contact centre are trained to help you, or if they are unable to assist, they will refer you through to me. We need your questions because that's how we know what kind of information or guidance people need. This is all new to us, so please don't be shy. If you have a question, you can guarantee that lots of other people have the same or similar. And I'll also let you know that after this webinar, we'll be emailing you out the handouts that were unavailable during the session. So don't worry about that, you'll get that information as well. When you come to our website, there's a few things to note. You can click on the menu or tab on the front page to go to the information about the new performance report. This is where you can sign up to our newsletter. Please sign up, as this is how we can communicate new resources to you. You can also access my blog posts on the new reporting standards from the home page under Hot Topics. On the blog pages, you can sign up to receive notifications about future blog posts. So what we're going to do now is I'm going to read out some of the questions that we've been receiving while we've been doing this webinar, and I'll try and get through as many as possible. But if I don't get to yours, we will be collating and publishing the questions from all three of the sessions on our website soon after the series is finished. Okay, so first question. We use Xero, a great New Zealand company. Have you liaised with some of the accounting systems so that the information we input during the year can simply be transferred over? We could then type in the story of what we do. So Xero has got a template built into its practice edition, which is the version that accountants use. And that is compliant with the standards. So if you use Xero, then you can use those templates to prepare your performance report. At the moment, there's no link built between Xero or MYOB or those quite common accounting softwares and our website, but never say never. That might be something that we would look to in the future, but as you can imagine, that would be quite a massive project. Second question, can you choose to report on different outcomes and outputs each year? And if so, how do you complete the template to compare to previous years? So if you have reported on an output this year, 2016, then we would expect that you would carry that over to the comparatives column for next year, even if you didn't do that same output in the following year, so you should just put 0 by it. So no, you don't have to report on the same outputs and outcomes every year because they might not be relevant to your charity going forward, but it's the same as with the financial information. When you carry your financial statements forwards, you would include everything that you had in the prior financial year in the prior year column. Keeping money from members separate from non-members, does this just apply to membership subscriptions? Or, for example, if you are hosting an event and both members and non-members attend, do you have to record those income streams separately? Yes, you do, and it could be a little bit tricky. So what we say is just give your best estimate of what you think it might be. So say you were having a quiz night and you had 25% members and they brought a whole lot of their friends, so it was 75% non-members. Just give a reasonable estimate of the split there, and if you wanted to, you could disclose how you've arrived at that number in the notes. What should we do with grants received in prior years that have been recorded as a liability but do not meet the use or return criteria? Then you should recognise them in the current year's financial statements as revenue or a receipt. If we currently prepare consolidated group statements, then it would remain the same. What you need to do is you need to have a look at the standard that governs consolidation, and that's actually a Tier 2 standard. It's called IPSAS 6, and what you should do is have a read of that and see if you meet the definition of control. If you have already been consolidating, then it's highly likely that you do control the other entity, but you need to do it under that standard. So even if you're a Tier 3, then you still need to use the Tier 2 standard for the consolidation process. Tier 4 entities do not need to consolidate. Does the requirement for audit apply to just the financial accounts or the whole performance report? This depends on whether the requirement to audit is a statutory requirement or if it's self-imposed. So if you have over $500,000 of annual operating expenses and therefore under the Charities Act you are required to have a review or an audit, then yes, that review or audit covers the whole performance report including the non-financial information. If, however, you choose to have an audit or if it's in your rules, but you haven't reached that statutory threshold, then you can specify to your auditor or reviewer which parts of the performance report you want to have reviewed or audited. Where on your website do we find the information that you referred to about related parties? If you go to the tab that says New Reporting Standards, a drop-down list will come up and it's under there. Could you please repeat how to record the unused portion of a grant? So first of all, you need to check the contract of the grant and see if there is a specific use or return condition. So you can only carry forward to the next year an unused portion of a grant if there is that use or return condition. So if there is that, what you would do is first of all record it as a liability or income in advance on your balance sheet, and then as you use the grant up you recognise it equally as revenue and an expense at the same time. Are charities equal or less than $500,000 operating expenditure required to provide a review by a qualified auditor? No, so only the statutory ones, so above $500,000, have to be performed by a qualified auditor. You mentioned at the start that you choose a tier and report on that, but we've heard from our auditor that we can apply Tier 3 but adopt Tier 2 for a type of transaction. Is that correct? Yes, that is. So for example, you might want to apply the Tier 2 standard for property, plant and equipment and revaluation. But if you do that, you have to apply it to all transactions of that type. You can't do it for just one, like just for buildings, for example. It have to be all property, plant and equipment that was covered by that standard. For a Tier 4 charity, do we have to write out every little thing purchased during the year in a statement of receipts and payments? So no, what you would do is you would look at each item that came out of the bank account, and you would classify it into the minimum categories. So there's about 4 or 5 minimum categories for money going in and money going out. So you just group them into those amounts, into those categories. As a Rotary charitable trust, we make donations to the Rotary Foundation. I presume this will be a related party. Yeah, it really depends on if one of those organisations has significant influence over the other. If they're not actually related, then no, they wouldn't. But if you, say, for example, had somebody on the board of both of those organisations, then it could do. So, yeah, you might want to have just a closer look at the relationship between those two organisations. If traditionally we did accrual accounts and we are treated as Tier 4 now, how do we go from accrual accounts to cash basis in the first year that we adopt the new format? It's relatively straightforward. You don't have to do any restating of comparatives. You don't even have to fill in the comparative column if you don't want to. So you just, it's almost like starting afresh. Under the cash basis. The only thing that you might find a bit different is if you've had assets that you've been depreciating. So what you can do is put the assets in your statement of resources and commitments at a value that you feel is most appropriate. So you might decide to put them in at cost, or you could put them in at net book value, but you just don't depreciate them any further. Yet they'll just remain there until you've written them off. If a Tier 3 charity provides grants to other charities, what will it be classified as in the Statement of Financial Performance and Statement of Cash Flows? There's a category called Donations and Grants Paid. It would just go under that category. Does a church therefore have to distinguish between donations from members and non-members? They would all be attendees, but most churches have more attendees than members. So yes, you would, and it's really up to you how you would classify that. If you've got a regular congregation and people who are actively involved in the church, then maybe those would be members, and people who sort of just turned up sporadically, they might be guests. That's really going to be a matter of judgment, because, for example, if you're trying to record the collections made weekly, you don't know who gave what. So just your best estimate, really, and you could put that in a note if you wanted to explain your rationale for that. We have a charity client who believe they will not bother to have an audit this year despite their rules requiring it. What effect would this have from your perspective? If this was brought to our attention, and quite often people do make complaints to charity services that people haven't followed their own rules. So if this happened and it came to our attention, we would get in touch with that organisation and advise them that they should be following their rules. But really, it's the charity's place to follow their own rules, not, we don't have any legislative power over that part. But if they don't want to do an audit and they don't feel that it's valuable, they should just go and change their rules, really. That's the simplest thing to do. If you are giving the grant, not receiving, and there are use or return conditions, is accounting for it different now? No, you just record it when you pay it. Please confirm that an audit or review is only required if expenditure is greater than $500,000 for 2 years in a row. Yes, that's correct. So what you're doing is looking back at the prior 2 years. So for 2016, you'd be looking back at your expenditure for 2015 and 2014. And that's actually the same for when you're determining which tier you're in as well. So the reason that you have to look back at 2 years is because some charities have fluctuations in their expenditure. So it's so you don't want to be bouncing up and down between tiers or whether you need a review or not. So for a grant that has been provided for a 12-month period that crosses over 2 reporting periods, do you now not accrue for the unused portion of the year end? That's correct unless there is a use or return condition. So for example, if you received a grant which was to cover 12 months salary, if there was no use or return condition, you would record it all as revenue when you receive it. So this is going to give you the situation sometimes where you have the income in one year and the expenses in the other. If a charity can opt out of having this statement of service performance being audited, should the auditor get this in writing? Well, this would be something that would probably be covered in your engagement letter with the auditor. You should definitely discuss this before you start, before the auditor starts, as to which parts they're actually going to look at. And it also needs to be explicitly stated in the audit opinion or the review opinion which parts they looked at and which parts they didn't look at. Can you confirm that last year comparatives are not mandatory for Tier 3 in the first year? Yes, that's correct. So what the standard actually says is that you should attach last year's financial statements to this year's performance report. However, if you're filing your accounts with Charity Services, in most cases we do have your prior year financial statements on file anyway, so we're not requiring people to do that unless it's your first year of reporting. If we missed a previous year of submitting financial returns, do we have to submit it now with the new template framework? No, you can do it in whichever format you prefer up until 31 March 2016. However, saying that, if you are going to prepare your 2016 accounts at the same time, you might as well do both of them under the new format. Somebody has just suggested for the church that they'd record the automatic payments for donations and envelope donations as from members, but the collection plate as non-members, which, yeah, that actually makes sense because if you go to a church regularly, then quite a lot of people do pay by automatic payment, and then it's just the people who turn up occasionally who might put the cash. So whichever, you know, you guys will know your members better than we do, so it's whatever is appropriate for your organisation. Why do we have to keep the member income separate from non-member income? What's the rationale for this? This is so that the reader of the performance report can get a sense of how much the organisation is self-funding versus getting funding from external sources. Does a review have to be performed by a chartered accountant? No, it doesn't, unless it's a statutory one. So if you're talking about one below $500,000 of operating expenses, it can be done by anybody that you think is suitably qualified. However, one thing that's really important to note, especially for the chartered accountants that are listening, that are performing audits and reviews, you are bound by your code of ethics to follow the standards that are set by the External Reporting Board. So therefore, if you're doing a non-statutory review and you're a chartered accountant, you must follow the review standard, which is available on the External Reporting Board website, and we will be keeping an eye out for those ones. There's some examples in the back of the standard of what the review opinion should look like. So if you've signed your name off Chartered Accountant and you've put the wrong format, then I'll be looking for you. Does the audit need to be done before the accounts are submitted to Charities services? This could be quite difficult time-wise. Yes, ideally, because the accounts are publicly available, so you really want to put your final version that's been checked and any errors sorted out. You've got 6 months from your balance date to when you have to file. So for example, if you're 31 March balance date, you've got until 30th of September to file your accounts. And incidentally, I've actually just done a blog post on this very subject, which will be out this week, and I've put a suggested timeline of how you can fit all of that, that process in. So if the end of year is 31 December 2015, do we not submit the new standard reporting until 2017? Yes, that's correct. So these standards are mandatory from periods beginning on or after 1st of April 2015. So a December one would start in January, which is before April, so you don't have to follow it yet until the next year. When a client pays a monthly fee for your service, does that class them as a member? I don't know the specific circumstances that you're referring to, but it could do. It just really depends on the way that your organisation operates. So, I mean, the most obvious example of members is incorporated societies, and you actually have to pay a membership fee to be a member and then have a say in the way that the organisation is run. But if somebody's literally just paying for a service but they don't get any rights for that money, then no, they probably wouldn't be a member. So I'm just scrolling through to just check if there's any more questions that we haven't answered. Can you please explain again about if you are a not-for-profit and a registered charity about talking to the Office of the Auditor General? So this is in the situation when you might be a public class as a public sector entity. So under the banner of public benefit entity, there are 2 sets of standards. There's the public sector ones and the not-for-profit ones. So there is the situation where some public sector entities are also registered charities. If you are a public sector entity, then you should be following the public sector standards, but if you're not sure which one you are, then check with the Office of the Auditor General, because they have a list obviously of everybody that they look after. It's also defined in the Public Audit Act whether you're a public sector entity or not, so you could check the schedule at the back of that Act. For the most part, public sector entities that are also registered charities are likely to be schools or preschools. Can we upload the completed template documents into the Charities Register? Will we need to upload financial reports or any other information into the Charities Register? So the performance report is the new way of doing your financial statements. So this should, in theory, be the only end-of-year document that you need to produce. So yes, you can upload directly the Excel template, or if you want to make it look a bit nicer, turn it into a PDF document. because as I said before, there's a lot of people looking and you want it to look as nice as possible. So no, you don't need to upload anything else if you've uploaded a completed performance report. Okay, so if anybody else has got any burning questions, if you could just quickly type them in now, because I think we've probably gone through most of the questions that are applicable to most people. Oh, what is the difference between an incorporated society and a charity? So the Companies Office runs a register of incorporated societies. Incorporated societies is a legal structure. So it's got members and limited liability. And a registered charity is an organisation that has a charitable purpose and is registered on the Charities register. So you can actually be both. You could be an incorporated society because that's the most appropriate legal structure for your organisation, and you could register as a charity. But we also have charities that are trusts or companies as well. In terms of disaggregation of categories in the profit and loss, how much disaggregation is acceptable? Well, it says in the standard that you can disaggregate, but only if this would add value. So listing every single account in your general ledger is probably not going to be that useful to the readers. So just have a think about what do the readers of this performance report really need to know? What are the most important income and expense categories for them? So less is more, really. Just a clarification, when you're submitting your report to Charity Services, there's two parts to the process. So it's an annual return and you're attaching your performance report. So when you log on to Charity Services website, there's a form that you need to fill in, and this year we've updated the form so that the minimum categories match what in the standards, and that's just to make it a lot easier to fill in. So you need to fill in the form, you need to update your officer details, and you also need to put in their date of birth. That information is not publicly available. Once you've filled in the form, then you upload your performance report and you've completed the process. Being a not-for-profit community childcare registered as a charity and incorporated society, are we classified as public sector? It's probably unlikely, but yeah, you probably know because you would have had the Office of the Auditor General knocking on your door by now. Oh, remind me of the version of Xero that fits the criteria. So it's called Practice Edition, and it's if you're an accountant and you have several different clients who are linked to you through Xero. So you know they also call it Green Xero, whereas individual people who have subscriptions, it's called Blue Xero, and the template is called PBE Tier 3 and PBE Tier 4. The reporting template for Tier 3 shows no reconciliation of cash surplus or deficit with the operating surplus or deficit. Is this correct? Yes, that's correct. You don't have to do that note anymore. Are incorporated society reporting requirements changing? Probably. The Incorporated Societies Act 1908 is currently being rewritten, and there's the bill is open for comment at the moment, but one of the provisions of the bill is that incorporated societies will have the same financial reporting requirements as charities. So if you feel very strongly about that either way, then you should make a submission to MB. Does Xero cater for the Tier 4 reporting? Yes, it does. Can you please give us some examples of an output versus an outcome? So if I go back to the example I used for grants, which was making sandwiches for lunches for children, the outcome would be to ensure that children at XYZ school get lunches every day. So that's the thing that you're trying to achieve, and then the output would be how many lunches that you've made during the year. Does MYOB have the reporting standard requirement? Yes, it does, but again, it's in the version that accountants use. It's called Accountants Office, and yeah, there's a template in there. If you're not connected to an accountant but you still use MYOB or Xero or QuickBooks, something like that, you can use a program called Calxa, C-A-L-X-A, and that has a reporting tool that you can feed your financial information into, and it will build you a performance report from that information. Okay, I think that we've reached the end of our questions. Some questions we haven't answered directly because we might do a little bit more thinking about that, but we will definitely be collating them and publishing them either on our website, or we might email them to you directly. A recording of this webinar will be available tomorrow. It will get emailed to you, and later on we will also put the recording on YouTube, and there'll be a link on the XRB and Charity Services website. If you think of any questions after the webinar, please contact Charity Services directly rather than the email address for the webinar, as we'll be collating the questions at Charity Services. So thanks so much for joining us today. It's been really great to see the high level of engagement and interest that people have shown, and a great big thank you for all the work that you do to support your charities. We really appreciate it. Thank you.